Good morning. Welcome to today's morning blast with myself and Mr. Michael Brown. It is Wednesday, the 12th of March. And before we go any further, I will get the legals out of the way. As usual, nothing discussed on this basis session constitutes trading or investment advice or infers any kind of endorsement by PIQ Global Limited, Traders PIQ or PIQ Suite, or indeed that of the hosts, which, as you know, is Mr. Michael Brown and myself, Mr. Ryan Paisley. Good morning, my friend.
Good morning. How are we?
I'm very well, thank you. How are you?
Oh, living the dream, mate. Living the dream.
Oh, brilliant. That's exactly what I want to hear. He's probably got aircon. He's probably got a coffee.
I haven't, actually. I should get a coffee. But no, I haven't had a coffee. Yeah, well, I'll have to make it myself. That's the problem.
What's the euro trading? Am I in danger of losing your lunch?
Oh, mate, you are very close to losing your lunch. 109.43 was the high that we got up to yesterday.
Oh, what was the low? Like 102 something, 103 something?
Well, Bloomy had the low at 101.40 on a Sunday night in a very early print back in the day.
But being the gent you are, you did admit on Friday night, where a few of the people listening in did come for beers, which was a nice evening. You did admit that at this point, neither of us would have been right for the right reasons.
Oh, absolutely. But, you know, I don't care, really.
It
doesn't matter why you're right.
Oh. I hope that kills you. There's still a bit of hope that it comes back. But anyway, moving on. What's happened yesterday?
Fuck me. What did happen yesterday? It was an absolute shambles of a day, to be completely honest with you. We started off with sentiment relatively firm, markets relatively steady. Then President Trump decided that he was going to be doubling the tariff on steel and aluminium imports from Canada to 50% from the prior 25%. So, of course, equities took a bit of a lurch lower on the back of that. The S&P 500 briefly trading down more than 10% from the record closing high and dipping its toe into correction territory. Then we went back to where we were, being risk on again on news that Ukraine was potentially prepared to accept the US's proposal for a 30-day truce in the conflict that's going on there. And of course, as about 4 hours after announcing this doubling of tariffs on Canadian imports, Trump said that actually that wasn't going to happen and scrapped those plans entirely. And then about 10 minutes later, Trump said, well, I don't really care about what the market's doing. And we came all the way back lower again. So amid all of that complete and utter shit show, we ended up with the S&P closing yesterday down by about 0.75% and the NASDAQ losing about 0.3% on the day. Of course, this sort of an environment, I sort of keep harping on about it at this point, it's basically impossible for market participants to price risk at this moment in time. It's also basically impossible for any consumer or business to plan properly in this sort of a macroeconomic environment. Just to
capex.
Exactly, and how businesses are meant to be investing is beyond me. Just to put a bit of context around it, in the last 7 days, US trade policy towards China has changed, towards Canada, their northern neighbour, has changed 6 times, including twice in the space of 6 hours yesterday. It's just, it's incoherent, bordering on insane at this point, to be completely honest with you. Oh, it's definitely not fucking boring, mate. That's for sure.
You had a roll close by.
Yeah, the old coffee machine's been worn out at this point, I think. And it certainly ain't helping my hairline, which needs all the help it can get at this point. In any case, as markets were chopping around all over the place yesterday, I think one of the most interesting themes that we continue to see is this relatively broad-based dollar weakness. And I think this is really the market bearing out the uncertainty and effectively saying we just don't want to hold anything dollar denominated at the moment. It is too uncertain and too risky to do so, and as a result of that, it's an interesting change in dynamic because traditionally we think of the dollar and we go safe haven, bastion of stability. If you're looking for somewhere to just park cash and shelter, you go and buy dollars. The problem for market participants now is that actually of all the things that are exposed to what what's coming out of the White House and what market participants are hating is actually the dollar that is most exposed and most susceptible to swings on that. And as a result, we see the dollar continuing to soften against pretty much all G10 peers. The dollar index printing fresh year-to-date lows yesterday, cable up north of 129.5, and of course the mighty euro trading to a high of 109.43, and our lunch date gets ever closer. In terms of other catalysts and other bits and bobs to mention from yesterday, there are a few things that are worth mentioning. On the geopolitical front, we obviously had that news that Ukraine is ready to accept the US's proposal for a 30-day truce. That has also seen the US restart intelligence sharing with Ukraine. Of course, you can't have a one-sided truce, and it's going to be interesting now and pivotal, in fact, to see whether indeed Russia actually agree to that truce as well. I think Trump's envoy in terms of peace is off to Russia in the next couple of days, maybe next week, to try and get that over the line. Sticking with Trump, news that isn't particularly surprising, but the Wall Street Journal yesterday reporting that the Fed's Michelle Bowman is in line to take over the vice chair for supervision job. Of course, Michael Barr, who was previously doing this job, quit in the middle of last month, basically so that Trump didn't try and sack him. He is staying as a governor, but he's given up that supervision job. Bowman has pretty much always been the front runner for that. It has to be someone on the Fed board already, and it's only Bowman and Waller that Trump actually has put on the board. So it's always going to be one of those two people. In terms of other bits and bobs, a few ECB speakers over the last few hours. Ollie Rehn was talking about how they need to keep their options open on rates, which is very much in keeping with the vibe of ECB commentary in recent months and weeks, of course. And then we've heard from the Portuguese representative this morning, Centeno, sticking to what is a very familiar dovish narrative from him, noting that the economy is still burdened by high rates and that he would prefer if the ECB moves lower on rates sooner rather than later. Worth noting that Centeno is giving up the job from the middle of July onwards. Other things to note, sticking with Portugal, actually, another bout of political instability for participants to deal with. Their prime minister was ousted last night. He failed a vote of no confidence in parliament, so it looks like they are going to have a second general election in the space of 12 months in Portugal. And lastly, two other things from me. Firstly, in all of that mess of tariff headlines yesterday, it did get a bit lost, but we did actually have better than expected job openings data out of the States. JOLTS coming in at 7.74 million in January, up from the prior 7.6 million. Not enough on its own to completely set aside all of these growth worries, but nonetheless, it is just worth noting, although markets obviously shrugged that off very, very quickly. And lastly, in the tech space for Tom Talks Cars mainly, Meta platforms, they are apparently testing their first AI training chip. They are working with TSMC, Taiwan Semiconductor, to produce this chip, and it's all part of their kind of grand plan to reduce their reliance on external suppliers such as NVIDIA. And if those tests are successful, then they plan wider deployment of these chips in order to lower AI infrastructure costs. So bully for them, I suppose.
Also, speaking of Tom Talks Cars, if Tom could quickly at some point check his WhatsApp messages, because I need him to acknowledge something work related. But anyway, thank you for that, Mr. Michael. Oh,
too busy complaining about paying £7 for a pint of cloudy IPA, I think.
I saw that last night. I was like, oh, geez. Michael, before I crack on with highlights from Zach's very good, as always, overnight news roundup. Look, as we all know, I hate the old tinfoil fedora. But before, as Trump was coming into office, there were some few people saying, look, do you know what? There's every chance he's going to try and drive the stock market down, and drive the dollar down and all that stuff, and basically try and force the Fed's hands to cut rates.
Yes.
At first, I thought it was bullshit. I'm not saying I completely agree with it now, but I'm starting to kind of slowly think, do you know what? It's not kind of that far away from the truth, because, yeah, I don't know.
I hate to say it, but I do agree with you. And
I mean,
I wrote.
I don't want to commit too much because I feel dirty for saying it, but everything he's doing seems to be just stuff that's rinsing the market and kind of driving the Fed to act, which is a bit weird.
I think, yeah. I mean, again, I don't want to go down this, conspiracy theory rabbit hole too much, but and I wrote about this in a note earlier in the week. I think I threw out a tweet about it probably as well. But I think there is a point and a bit of credibility to this, because if you think about the sort of overarching ambition of the Trump administration, as much as one exists, it basically, the mission statement is effectively, you've got a finite amount of economic resources from a macro perspective. We want to take them out of the public sector, which we see as wasteful and unproductive, and free it up and put it into the private sector, which we see as more productive and as an engine of economic growth. Now, if you're going to do that, fair enough. I'm not going to debate the merits or otherwise of doing that now. But if you're going to do that, it's going to be quite a messy process in order to reallocate resources around the economy like that. So I can see why it is politically expedient to do it now, do it aggressively, and effectively, because Trump's come into office, inauguration day on the 20th of January. You've probably got 9 months in which, if the economy does slow, if things roll over, if shit hits the fan, you can, from a political and man in the street perspective, blame the bloke who was there before you and say, actually, we just got a really shit inheritance from Joe Biden. They were papering over the cracks. Really sorry, not my fault, Gov. I'll do my best to sort it out. So I think from a political perspective, do this massive reallocation ASAP, do it aggressively. If there is a slowdown, then you're going to get a couple of Fed cuts in the mix as well to help things along. And then Trump, Bessent, Lutnick, whoever the hell is kicking around in the Oval Office early next year, they can then take credit for the turnaround into the midterms in November 2026. And I know it sounds mental to be thinking about the midterms now, but you've kind of got to play the long game. And again, I don't know whether that's the thinking or not. Maybe we're giving them way too much credit in saying that there is a grand plan.
This is the problem, because if that's what they're trying to do, they're playing a blinder. But do I have faith that that's what they're trying to do? It's like, oh God.
Yeah, and I think the other point I would make on that is, I think, firstly, it's the only. I've spoken to a number of people about this now. Far more intelligent than me, and certainly far more intelligent than you, Ryan. And basically, all of us are sort of in agreement, which is worrying, where you kind of go, actually, it's the only logical way that you can reconcile all of the various sort of jigsaw pieces that are moving around. The worry I have, and it is a big worry, is not on the same scale, let me stress, but if you think back 5 years ago, literally 5 years ago today, we were right at the start of the pandemic. We were shutting down economies left, right, and centre. And I think everyone, probably most people, 99% of people, made what proved to be the wrong assumption, where you just go, well, give it a month and we'll just turn everything back on and things will be how they were and we won't have to worry too much. The issue and the concern I have with what Trump and co are doing is it's actually pretty easy to engineer an economic slowdown. If you want unemployment to go through the roof, you just sack all your federal workers. If you want GDP to fall, you just throw a load of tariffs on and trim government expenditure. The issue is, how the hell do you turn that around again? Because that is much, much, much harder, much easier said than done to revive things again.
Yeah, and you need everything to go right if you are trying to turn it around. And even then, it won't turn on a sixpence.
Yeah, absolutely. So, I think it's politically, potentially clever. If I put my macroeconomist hat on, it's dangerous, potentially.
I completely agree on all counts, which is very, very concerning for probably you more than me.
Incredibly.
I love a healthy debate that we've brought to the table today. But anyway, cracking on with some of Zach's the highlights from the overnight news roundup before we waste people's time even more. Although, actually, it's probably good use of time because you get to listen to me and Michael Brown. Well, Michael Brown being smart and me just nodding and waving. So, starting off with US steel and aluminium tariffs, China's responded to it will take all necessary measures to safeguard its interests, while the EU imposed countermeasures of 26 billion euros of American goods. France's European Affairs Minister Haddad said the EU could go further, warning a trade war benefits no one. Sideline on this, but still tariff related. The US also criticized Japan's high rice tariffs, hinting at further reciprocal measures.
Hopefully, there's a grain of truth in those reports.
Oh God!
sorry.
Did you just come up with that on the fly?
Yes. Well, I don't see your notes beforehand, do I?
Notes? What?
Well, Zach's notes.
Yeah. House GOP narrowly approved a funding bill
GOP.
through fall.
Do you mean GOP?
Yeah, the GOP. Mostly along party lines, setting up a Senate fight. The House also delayed lawmakers' ability to force votes on revoking Trump's tariffs and immigration policies. Market impact and rate outlook. Goldman Sachs sees ongoing hedge fund de-risking. Credit strategists raised the US credit spread forecasts amid tariff risks. That's according to Reuters and Bloomberg. Traders are betting. Yeah, go on.
I was going to say Goldman have also cut their S&P forecast. In case you may have been about to get onto that, but they're down to 6,200 from 6,500 now.
Aye. Traders are betting the Fed may cut rates more than expected this year, fearing near-term economic weakness from tariffs. Ray Dalio warns of looming supply-demand problems for US debt and could disrupt the global economy. BOJ Governor Ueda reiterated the bond yield should move freely, signaling no immediate yield curve intervention. Japan's wholesale inflation hit 4% in February, matching forecasts, adding to near-term rate hike speculation. Major Japanese firms agreed to a third consecutive year of significant wage hikes, which will please the BOJ. China developments, Walmart executives were summoned after the retailer reportedly urged Chinese suppliers to absorb tariff costs. Alibaba, Alibaba's Joe Tsai, I'm guessing, said that Xi meeting with entrepreneurs lifted business confidence. Good for him, but I'm pretty sure he's said that with a gun to his head, perhaps not just figuratively. The yuan reached a 4-month high versus the dollar. Consumer tech shares in China and Hong Kong dipped on tariff uncertainty. China issued more copper export licenses, potentially boosting outbound sales amid a global market shakeup. Australia and UK wise, Australia will not impose reciprocal tariffs on US metals. The Australian PM said yesterday, according to Reuters, or last night maybe. UK PM Starmer defended cutting foreign aid to bolster defence spending, while the government plans to abolish the payment systems regulator to reduce unnecessary regulation. These would be the same regulators that they were approaching last month to ask for tips on growth. Greenland's opposition party won elections, favouring a slower move towards independence from Denmark. Houthis threatened to resume attacks on Israeli ships after aid cut off to Gaza. Sweden on EU defence, they call for stronger European military ties within NATO, but more independent of the US, focusing on areas like space and satellites. Regarding China, Iran and Russia, Beijing to host talks with Russia and Iran on the Iranian nuclear issue, signalling continued diplomatic engagement in the region. Intel shares have jumped in extended trade on rumors that TSMC pitched Nvidia, AMD, and Broadcom and Qualcomm about a JV to operate Intel's factories. Now, I'm assuming, I've not read the article, I'm assuming this will be Intel's factories in the US, which, they've been given billions and billions to build, but then they've realized they ain't got much to build inside them. So that seems to be just using up the factories over there, which I know previously Trump's been quite bullish about. In terms of corporate and market news, what have we got? Salesforce plans a $1 billion investment in Singapore over 5 years, following other US tech companies eyeing Southeast Asian growth. Remental projects a 25 to 30% sales boost in 2025 from global rearmament. Jesus, put my teeth in trends, despite missing full year 2024 estimates. Porsche maintains dividend despite a 30.4% profit drop, citing cost pressures and stiff competition in China. The Swiss IPO outlook, the SIX exchange warns US political turmoil could delay some listings, even as overall pipeline remains robust. Obviously, unless you've been living under a rock this morning, Northvolt's bankruptcy is all over the wires. The Swedish EV battery startup filed for bankruptcy, ending hopes of a strong European challenger to Asian battery giants. They ran out of charge. I'll get that.
Oh, you fucker.
Oh, come on. You were waiting for me to take a breath, and that was coming from you, so I'll just beat you to it.
To be fair, the boys at New Squawk have already threatened to kill me for having made that pun this morning.
Oh, yeah, your name was Muck on Sunday when I was out. Finally, for me, before we go back to Michael, Rio Tinto raising $9 billion in US bonds to fund its Arcadium lithium buyout. That's according to Reuters. But that's it from me. There's a full rundown of the overnight news roundup on my pinned tweet, courtesy of the awesome Zach. And now back to you in the studio.
Good stuff. Thank you, Ryan. Must be coming up to time when Zach's going to take another holiday soon. He's been here for 2 weeks.
Yeah, exactly that.
Right. In terms of today, then, of course, it is, nice to actually have some meat on the bones in terms of the data docket today. There's actually a few bits and bobs going on. Highlighting the calendar at 12:30 this afternoon, London time, will be the February US inflation figures. CPI is due this lunchtime. On a month-on-month basis, headline prices seen rising by 0.3% in February, while core prices are also seen rising by 0.3%, both of which will be modestly cooler than we saw in the prior month. On an annual basis, meanwhile, headline inflation, that's seen coming down to 2.9% from a prior 3%, while core prices are also seen falling to 3.2% from a prior 3.3%. Going into the CPI data, at least when I checked about 20 minutes ago, leaving the desk, the OIS curve for the United States pricing around about a 5% chance that the Fed deliver a 25 basis point cut at their March meeting next Wednesday, with the next 25 basis point cut fully priced by the June confab, with a total of 78 basis points of easing discounted by the end of the year. To be completely honest with you, though, it is pretty difficult to imagine today's CPI figures materially shifting the policy outlook for the FOMC. I think the data is really just going to reinforce the idea of a bumpy disinflationary path back to the 2% target, as Chair Powell was outlining this in his remarks towards the back end of last week. Nevertheless, having said that, I do think we would, in the event of a surprise either way against those consensus figures, I do think we would probably see a more significant and more aggressive market reaction in the event of hotter than expected data as opposed to cooler than expected data. This is very much in keeping with the vibe that markets have been viewing US figures with recently, whereby poor prints, whichever way you look at it, are effectively further endorsing the idea of a growth slowdown and also potential risks of stagflation, whereby better than expected data is not really doing enough to allay those concerns given all of the shenanigans going on the trade and the tariff front. Besides the US inflation figures, we do have a policy decision due today from the Bank of Canada at 1:45 this afternoon London time, with Governor Macklem then to hold a press conference around 45 minutes later. The BOC expected to deliver a 25 basis point rate cut, lowering rates to 2.75%, and that would be broadly in line with market pricing, which fully discounts such a move today, while also pricing a total of 80 basis points of easing by the end of the year. Of course, the BOC's guidance and commentary around that decision likely to be squarely focused on the issue of tariffs and noting their preparedness to support the economy no matter what happens amid that uncertain economic outlook. In terms of other bits and bobs today, we do have a frankly ridiculous amount of speakers from the ECB. We've already heard from about 4 or 5 this morning. Lane, Panetta and Nagel are going to be speaking throughout the remainder of the day. It is the annual ECB Watchers Conference today that they're all speaking at, which sounds like a really thrilling event to go to. I'm absolutely gutted that I didn't get an invite this year. In terms of other... Sorry?
I just laughed.
Oh, in terms of other things to focus on, we do have supply out of the States today, a 10-year auction at 5 o'clock this afternoon. We had a 3-year sale yesterday, which tailed by 0.6 basis points, so a little bit soft there. And on the earnings front, of course, we are through now the vast majority of Q1 earnings. But nonetheless, after the market closed tonight, we do get figures from Adobe, which might be worth watching for any of the tech folk out there. And that is pretty much it from me this morning.
Absolutely amazing. I've enjoyed today. Thank you so much, Mr. Michael Brown. Anyone that's going to Cheltenham or just gambling on the horses later on, good luck to you. Anyone trading today, good luck to you.
To be honest, not
yeah,
investment
exactly.
advice, but I reckon Cheltenham trumps markets at the minute. You're more likely to make money on the horses.
Exactly that. Exactly that. Whip that nag, you slag.
Oh, fucking hell.
Right, on that note, we'll see you tomorrow. Goodbye.
Goodbye. Jesus.